Good morning, everyone, and welcome to the North County Estate Planning Council's August meeting. My name is Charlene Wallach. I'm the Chief Impact Officer here at the Jewish Community Foundation, and we're really happy to host these monthly webinars. As you all know, the Jewish Community Foundation has been around for more than 50 years. We've facilitated over $1.6 million in grants, and we are the largest grant maker in San Diego. In addition, you should know that we've been recently raising several $1 million in the COVID-19 emergency relief efforts. Many of you have contributed, and we appreciate all the community support. It's important to note that we are a community foundation operating under Jewish faith-based values, which is in line with most faith-based values, of course, and we have a vast expertise in both overall philanthropy and the landscape of nonprofits in San Diego. Please don't hesitate to reach out to us if you ever have any questions or need advice about San Diego issues or their philanthropic solutions. Many people don't realize that the vast majority of philanthropic dollars granted from JCF donor advice funds go to non-Jewish organizations in San Diego and across the country. And donors do not need to be Jewish to hold funds with us. The Trusted Travel Advisor program, which is a program that we started here at the Jewish Community Foundation, is to help individuals who are working in the professional advisor field advance their relationships and their conversations with their clients. This program is a monthly program. It's a lunchtime workshop. We used to have actual lunch where you can learn to have robust conversations with your clients and discuss approaches to strengthening your conversation. In fact, many of you have participated in the program, and our own Bill Super is a current participant in our TCA group. So we welcome you to find out any more information that you would like from us. Now, as ways that we can support you in the work that you do, which we're just so proud of, is to really facilitate complex assets, work with unusual opportunities for you to engage with your clients in tax-efficient ways to build philanthropy. And I know through these sessions, you certainly learn about many, many different ways. So we encourage you to reach out to us. We are a resource for all of you. We thank the NCPC for the opportunity to partner with you. And we look forward to a really exciting program today that Bill has put together. So with that, I will hand off to Roberta Robertson, who will make the introductions and take it from here.
Thank you very much, everyone. Thank you for attending. We especially want to thank Ollie Bean and Charlene Wallach of the Jewish Community Foundation for all their help in setting up and running the seminar. Better you than us, that's for sure. Mark off your calendars for September 1st meeting from 7:30 to 10:30. It's a 3-hour online meeting to listen to Natalie Choate, who is the nationally renowned IRA expert. It's really quite a presentation. Webinar alert will go out shortly so that you can register. We will be giving continuing education credits for attorneys and CPAs for a 3-hour program. There will be a presentation fee because it is a payment to Natalie. Members will be charged $50 and guests will be charged $100, which is an incredible bargain for a 3-hour course from a nationally renowned expert. Also, Natalie's book will be available for half price for $45 if we purchase them in quantities. So please let Bill Super know if you would like to purchase one. At this point, we don't know when we'll be getting back into Fairbanks Ranch Country Club. They're keeping us apprised, but it is up to the governor. Also, if you're interested in if you're interested in the Trifecta's virtual networking opportunity, please email Bill Super at wsuper1gmail or Pete Tentler at pete@reversemortgage1776.com and let them know of your interest in the networking. We want to say thank you to Joe Willett, the council's founder and fearless leader, who's moving to Jacksonville, Florida. You've probably seen that email come through. We were going to have Doug Wilson of Doug Wilson Companies do a brief presentation. Is he available at this point? Not yet. All right.
Bill Super is going to be doing his introductions for him.
Bill, would you like to do it at this time, or we should go on with our presentation?
No, we'll just go real quickly. I know Doug well, and of course he's been a key member of the council, and he, along with Robert Valera, are my two guides in our Planning for Real Estate Families series, which is, of course, a very unique world. But Doug is caught up in some technical difficulties, but you know, Doug is the consummate developer, workout, getting started back in the days of the savings and loan crisis, developer of the Symphony Towers. And in recent years, they certainly have continued in those arenas, but he's focused more on the real estate legacy portfolios with his clients, large and small. In that process, which will sound familiar to each of us, they have the discovery phase 1 of asset plus wealth analysis, phase 2, goals and desired outcomes. Phase 3 is preparation of legacy asset transfer plan. And phase 4 is implementation of asset transfer plan. Doug is a consummate worker in the scheme of bringing together a team of professionals. Obviously, he's certainly the expert in the real estate world, familiar with all areas of real estate from residential to commercial, industrial, and everything beyond, and then works with the CPAs, the estate planning attorneys, trust departments, and so on in developing an overall strategy that keeps the family's legacy real estate intact. They don't have to sell everything to turn into stocks and bonds. Doug and his team can help that process of finding the right folks for the right type of real estate and manage that on behalf of the beneficiaries of the family's estate. So take it away, Roberta.
All right. Before we start our presentation, just a reminder that if you have questions, please type them into the Q&A at the bottom of your screen, and our speakers will take questions at the end of their presentation. So our presentation today, extraordinary presentation, planning for the 30 million to 150 million taxable estate, from basics to the creative to the exotic. Our speakers are Phil Sullivan of Sullivan, McGibbons and Associates, and Mark Morris of Levitt Zacks CPAs. So gentlemen, please proceed.
Hey, thanks, Roberta, and welcome everyone. I'll be honest, I've never done a presentation like this over Zoom, so this is a new thing for me. And usually when I do presentations, we sit down and collaborate together. So Mark and I had to do that through the phone. So it's a new day dawning for me. So we'll try to adapt. But I appreciate the ability to present today. And I also appreciate the fact that Mark is doing it with me. One of the reasons why I felt comfortable doing it is Mark's knowledge of the Internal Revenue Code is incredible. And he's like a walking, talking IRS code. So when he called me or emailed me and said, would you like to do it? I was like, yeah, I'll do it with you, because I know you know everything. And so I was pretty excited. So thanks for doing it with me, Mark. So how we're going to do this is I'm going to kind of go through the presentation slides. So Charlene, you can click to the next slide. So this is just kind of an overview of what we're going to talk about. And we decided that we will start out kind of getting everybody awake, number one, and on with their feet on the ground so they can see exactly what we're talking about. And then we're going to sort of crank it up. And we also, in going through this and then kind of looking at all the time limitations, we came to the conclusion that there's probably going to be a part 2 or part 3 of this with maybe some other speakers. But we will today, we're going to talk about annual gifting, the lifetime exclusion, the clawback, low interest loans, and we're going to touch on life insurance, but I do think that's going to be another presentation of its own. Then we will go through GRATs. We're going to talk about Grantor Trusts. The CLTs, I think we're going to do in another time. And the life insurance, again, we're probably going to kick that to another presentation. You can hit the next slide, Charlene. If you can. Yeah, and then these are kind of an overview of the topics we're going to talk about today. Again, really the Gragan loans, and I'll mention BDOTs and BDITs, but those I think we're going to do in a separate presentation because they are kind of an element on their own. But the idea here would be to set the stage for those more involved presentations. So it's really going to be about just general things everybody can do in their estates. And then we're gonna get into GRATs, and then we're gonna talk about defective grantor trusts. And then Mark's gonna talk about private annuities and skins. So that's the topics for today. So I'm gonna set the stage. You can hit the next slide. And this is kind of an overview of my presentation and the presentation in total. And then I'm gonna start right now on the next slide, Charlene. So when I went to get my master's, I always enjoyed the adjunct professors because they had their fingers in the dirt and they had real life experience. When I was in law school, it was more they were teaching the courses, but they never really followed the returns or had the audits. So I really enjoyed the adjunct professors. And when I came out to San Diego and I started working Lose Forward, I actually was an adjunct professor for a little over 10 years with USD and Cal Western. And when I told my students at that time that I'm not going to do what the professors do in property tax and contracts, but I've been in audits. I can tell you practically what happens and how it works. So that's kind of what I want to do in setting the stage today, is to talk about the taxes that are at play and kind of some of the simple issues that people should think about, whether you have a $35 million estate or a more modest estate. And what's very interesting for me, when I started this, the credit was $600,000, top tax was 55%. Now we have these credits at over 11 million per person, and the rate's down to 40. So I'm pretty clear that it's going to change over time. So flexibility, I think, is an important thing. And one of the themes I'm going to say in this little 15-minute slot that I'm doing, I was going to time myself, is to make sure you understand what's going on in your client's mind. So let me first set the stage with the taxes. So what we have is 3 transfer taxes: the federal estate and federal gift tax, and they kind of work together. Other than the annual exclusion is a really big exception to those 2 taxes. There's a generation skipping tax, which we're going to talk about, and I'm going to show you how that's worked into the planning. But that too should be a whole separate topic down the road. And in fact, I went to Heckerling this year, and Reed Moore did an incredible presentation on non-skip trusts and what happens. And if you haven't had a chance to see that or read his paper, it's tremendous. And interestingly, on that tax, which started in 1986, it's now coming to fruition because as the time grows on, now these generation skips are occurring. So we'll touch on that one, but keep that one in the back of your mind too. But today, we're really talking about the interplay between income taxes and capital gains and the estate tax. So those 4 taxes, the 3 transfer taxes, the income tax is what we're talking about. And you're going to see as we go through this presentation, can we beat both of those taxes? And when we go through the various options, you'll see the idea here is to try to beat them all or at least mitigate them to the best we can. So one last tax, at least for us in California, is the California property tax. More and more that tax is becoming important. They're talking about changes to Prop 13. So whenever, and a lot of my clients, I say pretty much everyone have a home, but a lot of them built their wealth on California real property. So whenever you're dealing with California real property and making gifts or transfers or transferring them to partnerships with LLCs, you have to be cognizant of that fact. So that tax. So again, we look at all these taxes and we try to take a approach where we try to mitigate or eliminate all those taxes to the best that we can. Okay, Charlene, next slide. All right, so number one, absolutely is family situation and control issues. So you got to sit down with these clients and you have to get to know them and understand exactly what's going on in the family. There are tax plans and then there are family plans, and you have to get down to that situation. I've been in matters where especially when I was a younger attorney, I was just looking at the taxes, I'm banging the taxes down. I created this incredible partnership. Unknown to me, there was family disputes and the whole thing fell apart in litigation between the family members. So all the tax savings I achieved were kind of marginalized by the family situation. So get to know that situation and exactly what's going on there. And then in this topic though, we're assuming that there's not a family issue. We're assuming that everybody's working to mitigate or eliminate the taxes, but in real life, that is not always what happens. So make sure you're sensitive to that. Number two is the type of assets in the estate. So it is really important. Valuation is important. We're going to talk about valuation, but finding out the income tax basis on those assets. And if it's real property, what the property tax basis is. The bottom line is to get that information. It sounds easy, but it's a little bit harder than you think. I'm working with a client up in Northern California. He's got a CFO person he works with. Oh my God, she's giving me everything on a silver platter, the entire history of their assets, and he's heavily loaded with real property. And I'm kind of navigating with them how to go through it and achieve the taxes. But without that information and planning, you could end up getting stuck in a chuck hole and say, "Whoop, I didn't realize that there was a negative basis on this asset," or "I didn't realize that they just purchased this asset," and things of that nature. So getting all that information, fair market value, income tax basis is number 2 on the tick list of getting that information. So once you have all that stuff set up, then we talk about tax savings. There's really 2 huge deductions. There's the unlimited marital deduction, and then there's a charitable deduction. So the next thing I ask clients is, do you have a charitable interest? And if they have a charitable interest, that goes into a whole different realm. In this presentation, we're assuming that they do not have a charitable interest. They're saying, I want to reduce the tax and I want to get as much as I possibly can to my children or my family members. So again, if we do another piece on this and do the charitable side, we'll slide that in. Now, of course, people can have a mix, but in this presentation, we're assuming that the charitable interest is minimal. We're just looking at reducing taxes without involving a charity at this stage. Okay, and then the last thing, as we're setting the stage, is what I call the ag factor. So fees, complexity, compliance, aggravation factors. So I learned this as a young attorney. We did a family partnership. We did it late in the year. They paid their $800, and then next year came. They got their bill from the Sacramento for another $800, and they called me and they said, "Well, we already paid this." And I said, "Well, then you should be okay." And I said, "When did you pay it?" "Oh, we paid it last year." And I go, No. It's an annual fee." "Oh, annual fee. So every year we have to pay this fee?" And I'm like, "Yeah, every year you got to pay this fee." So I realized that I need to explain to them not only how this works, but to actually structure out and show them all the continuing fees. So with that in mind, we're going to go through this starting with less complex, and then as we crank up and we show these different elements and devices, you'll say, "Hey, there's more complexity here, and there's more fees involved, and there's more work that has to be done." So people think, "Oh, I just set it up just like my revocable trust. I don't need to do anything on it." No, these will require constant attention and work with your CPA. And that's why it's critical to have a good team when you work on these matters. I think that the estate planner is important. We structure it, but I think the CPA is critical in telling the client, this is what we're going to have to file every year. This is how we're going to have to make the payments every year. Because if you don't respect these transactions, that is the first attack the IRS will take, is this was all a bunch of nonsense. You set it up, but you never respected the deal. That is their first major attack. So you must make sure you tell them that this isn't just drop it in the trust and come back and see me in 20 years. That's not how it works. So really set the time and talk to them about the compliance issues and as well as the fees and costs associated with it. Okay, the slide here, real simple stuff. Power of the annual exclusion, 2503. So 2503 is a $10,000 freebie. It does not hit your basic exclusion. It is a freebie. It is just an incredibly generous, easy, de minimis gift. They have cost of living adjusted that each year. It is $15,000 this year. That is per person. So with a couple, it's $30,000. It must be a present interest gift. You must transfer it. So if you're doing it in a trust, you have to structure different things. But these are incredibly simple, easy things for people to do. And it sounds like it's, oh, it's not a big deal. It is a huge deal. So if you have grandkids and kids and times two, and then in-laws and such like that, you can bang out a ton of money if you do an annual gifting each year. So when I took this course in my master's, and the professor spent so much time, and this is when the exclusion was at 10,000, and I said to him, why are you spending so much time on this? He goes, what you can do with that little exclusion, if you're just religious about it, is incredible how much you can do it. So how to utilize it, more importantly, utilize it. And when you have these 35 plus $1 million estates, it's just a no-brainer to do those. So that one you should just do. And whether it's a birthday gift, and then people say, oh, I do Christmas or Hanukkah gifts. No, do it at the beginning of the year, because if you don't do it and complete it, it doesn't work. So don't wait till December. And if they don't cash the check till January, it doesn't work. So make them New Year's gifts, give it to them, let them deposit it. It's in the can, it's done. It's easy. 2503E, education and medical. So those are direct payments for tuition, direct payments for medical care. Again, a freebie. It's actually a wonderful statute, I think, to really help people out. And it is easy to use those monies. Again, just gets out of the estate, simple, get it done, and focus on that. So whenever you're sitting down with these high net worth clients, I think 2503B and 2503E are just no-brainers. Okay, last thing is ILETs. And tip my hat to Joel who's leaving. I really like life insurance. I'm one of those estate planners that likes life insurance. And I think ILETs are so undersold and unappreciated, is a better way to say it. They're boring. Oh yeah. They're dull. Oh yeah. But guess what? They work incredibly. You take those annual exclusion gifts and you can put them in a trust. You can take that money and buy a life insurance policy. And when the person passes away, it is out of their estate tax-free and income tax-free. And most importantly, which we're going to touch on at the end of this, liquid. It is a liquid pool of money. And everyone knows cash is king. So when I have people with huge wealth, or they've come in, they've gone from like a $20 million, which is good wealth, to like 150 million, and then they're in their 40s or in their 30s, and I look at these kids and I say, and now they're kids to me now, I say, do you guys have life insurance? Look into life insurance. I don't sell it. I just tell you to go look into it. And if you can take some of your exclusion or your annual, your basic exclusion or annual exclusion gifts and make those transfers, that is an incredible way to, just push wealth to the other side. And it's liquid. It is incredible. Next slide, Charlene. So to that end, when I started doing this, the gift tax was credit was 600,000. Then it went up to $1 million. And it was there for many, many years at $1 million. Now it is $10 million each, cost of living adjusted. This year it's $11,580,000. That's $23,160,000 per couple. And you can take a slice of that and make a one-time gift to an ILET buy life insurance, and you have that in the can. Used to be when you had to do the annual exclusion gifts and work with the crummy powers, it was a little more tedious. Here you could actually do one pay up. I don't know the costs associated with that, but when you have some of these younger people that are ringing the bell in their 30s, I think using a piece of your basic exclusion amount to cap a life insurance trust would be incredible. That will be another topic we're going to talk about, but I just lay that one out as an easy deal. Okay, so the way it sits now under the Trump Tax Act is that the $10 million is going to sunset on January 1st, 2026. I think it's the Byrd rule that requires that. And so we have that change coming down the pipe. So that'll be cut in two. That is subject, of course, to what's going to happen in November. It's also subject to Congress acting prior to that and extending it. But it is, it's out there now, and the question is, use it or lose it. So in last year, they did state that there will be no clawback. So you can use it and they won't claw it back. So it's there and it's available to be used. On that note, on number 3, you'll see plan for incapacity. So with some of my older clients, and I got clients that are in their 90s and in their 80s and they're still living full lives. But my concern is that what happens if there's a situation where they won't be able to complete the gifts. So you should look at the older clients and make sure you're addressing that in their estate plan so that their power of attorney permits someone to make the gifts, and that must also be concluded in their revocable trust. So plan for incapacity on that one, just in case. We'll talk about the step up in a second, but if you don't have those powers in there, then it's maybe more difficult for you to complete those gifts at that time. Okay, and then the next thing is generational gifting. You can go to the next slide, Charlene. So this just kind of gives you a simple diagram. There's your Grantor's Living Trust, and what you can do is you can set up a gift trust, and you can set that gift trust up and you make the transfer over, whether it's cash, partnership, or property. And when you transfer that over, what you're going to do is you're going to file a gift tax return. You're going to allocate your exclusion to it. You're going to allocate your generation skipping tax credit to it. And then inside that trust, you'll have the assets out of the grantor's estate, and it's going to grow in value. And then if you put it with generation skipping tax protections on it, when the child dies, it will not be taxed in their estate. So that is just a simple illustration there of just an irrevocable gift trust and how that works. Next slide, Charlene. So as I end this first 15-minute segment, the idea here is to get the appreciation out of the trustor's estate. If we used our generation skipping tax credits, you'll get the appreciation and value out of the child's estate. And then the last thing, again, could be another topic to talk about, is what jurisdiction to establish the trust. So in California, we're just not on the cusp of really good trust law. We do have a canning statute now, finally, but for the most part, there's other jurisdictions that have much better options. So whenever we're doing these high-end planning situations, we do discuss that. Delaware is kind of my favorite jurisdiction to go to, although we've done stuff in South Dakota and in Nevada, and to talk to them. And I'm a California lawyer, so we do liaison with counsel in those jurisdictions. But the bottom line for those jurisdictions is you can get better creditor protection. You can get perhaps some state income tax protection. And also, they just have far better decanting statutes available in those states. So that's the setup. Last thing I want to say before I'm going to hand it over to Mark to talk about GRATs is the step up in basis. So just to give you the interplay between the taxes, when a person passes away, the income tax basis in that asset gets stepped up to fair market value date of death. All the capital gain in that asset is then gone. So for example, if you bought a house out here in the 70s and the house was worth 100,000 and now it's worth 5 million, which I think is a possibility if you bought it on the coast, and you sold it, there'd be gain even if you had it as your principal residence. When someone passes away, that gain disappears and you get stepped up to the 5 million. If it is community property, you get the double step up in basis. and then the spouse can sell it. So whether or not to use your exclusion, you have to balance that between, when a spouse dies. Perfect example would, perfect plan would be one spouse dies, we get the full step up, and then we can do planning at the second death. So as we approach this sunset provision, we'll have to keep our eye on that and decide when to strike. I'm going to talk a little bit about what happens if there's a Democratic sweep at the end, but we go, okay, what happens if we lose our credit or something goes wrong? What can we do? And that's the setup for Mark to talk about GRATs. And GRATs is a great way to get value out. And with the zero out GRATs, which Mark will describe, you don't have to use credit. Okay, Mark, I'm going to hand it over to you.
Thanks, Phil. First, it's an honor to be able to address the estate planning community at large out there, and appreciate Phil, a dedicated estate planner, for joining me on this, and all the other sponsors. So I'm going to launch into a little bit of discussion of one of the four-letter acronyms that we use in estate planning quite a bit, GRATs, or Grantor Retained Annuity Trust. First of all, quickly, just a housekeeping. I see that there are a couple of in the chats, a couple of Q&As. I think Roberta's going to field those, and we'll have a little bit of opportunity, hopefully, at the end to address the questions then. So Grantor Retained Annuity Trust. They start out with a couple basics here. The whole idea of Grantor Retained Annuity Trust is to be able to have the actual earnings of a trust, if they exceed a certain hurdle rate, which we call the 75/20 rate, then the GRAT will generally be successful if the grantor outlives the term. That was a little bit to unpack right there. GRATs are among a basic type of GRAT is a pretty solid type of estate planning tool these days. They are creatures of Code Section 2702, and that came out of what was known as Chapter 14 at one period of time. So back in the day, I'm going to address, not in this order on the screen, but let's go to zero out GRATs just for a second here. Back in the day, there was an opportunity to structure the GRAT so that the annuity stream was large enough, or the GRAT term was long enough, so that the one could do a subtraction of the retained annuity amount and have a remainder interest that's either zero or near zero type of a structure. The service didn't, when they came out with the regulations on 2702, they originally did not think that you could do that. They came out with an example number 5. In fact, I think there was a quick little story there. A bookish type of individual called up the IRS and regaled them, why can't you have a zero out GRAT? It seems like the statute would allow you to have that. Lo and behold, they came out with example number 5 in the regulations, said you can't do that. And then along came a few years later the Walton case, so-called, and it was 2-year GRAT, and it had a near zero out remainder interest, just a few $1,000s on several $1 million put into the trust, and the unanimous tax court decided that yes, one can actually have something that's near zero out, and IRS eventually acquiesced. Thus we now have things that we have something similar to a zero out GRAT. And then there's something called cascading GRATs, or sometimes rollover. So the whole idea of a GRAT, again, is in most cases is for the grantor to outlive the term so that wealth can be transferred from one generation to another. GRATs tend to work well for just one generation transfers. They don't work well for multi-generational because they're not GST friendly. In particular, there are some other ways to perhaps address that particular issue, but it's primarily one generation to another. So, and the other thing to understand about grats is that they're really interest rate sensitive, this 75/20 rate. So next slide, please. So this is just a snapshot of my screen back in mid-July. The previous 2 months, I thought, well, the rates can't get any lower. The 75/20 rate for June and July was 0.4, but in mid-July, they published the August rate, and you can see it right there, 0.4. And I was like, it got lower. And you know, this is a key interest rate that is used in these estate planning type of situations that really will favor. So if you can earn, if the trust assets can earn more than that particular hurdle rate, the chances of success are greatly improved. Let's go to the next slide. So this is kind of busy, but it is it's an example of a real situation where someone has decided to do a cascading or rollover type of a GRAT scenario. And in this particular case, it's a 2-year, that's probably the minimal term that they would have to outlive. And again, this is for a transfer from one generation to another. You can grow GRATs under the statute by 120% amount, by a 20% factor every year. So if you see in this particular GRAT, the initial payout is like 47.85, and then it would be 120% of that the next year. You can see there's quite a bit of payout. And what in this particular instance, it involved a family that had significant wealth. They're trying to transfer wealth to the next generation. And so what they would do is every time they get an annual payment, then they would take that, and this involves some stock or other company stock, they would put that back into the next year's GRAT, and so they cascade or roll as the case may be. And so this is really a payment of the in-kind distribution. The whole idea is to try to get volatility, particularly appreciation, is your friend when you're doing a GRAT, and you're trying to get the tail end of more of that remainder wealth to transfer off. And if you keep doing it and just let it go, and you have the luxury of some time in your favor, they can be very, very powerful. In this particular case, this shows just one of the rolling GRATs that where you put in some funds on, maybe those are discounted at first, but anyway, with some healthy appreciation, maybe a couple $1 million transfers out. And anyway, you keep rolling around and rolling these through. Case in point, this particular family probably through a series of both rolling GRATs from one generation to the other, and sometimes they will stagger the GRATs and maybe do them a little bit longer depending on how they feel like interest rates are going to go, or if there's going to be prospective change in the law. Maybe they'll do it for a 3-year GRAT and a 6-year GRAT, and they had some 9-year GRATs. So all this, there was probably $500 million worth of wealth that was transferred over a 10-year period of time just by getting this in motion and getting a tremendous amount of wealth at very little cost. I mean, this one cost maybe taxable gift $76. So if they've used up their exclusion for other types of things, the rolling GRAT can work, but it takes time to do that. Next slide. Moving on here. Okay, again, this is now we're coming into something called a long-term GRAT type of strategy. It's a total interest rate play. It's not for those that are totally risk adverse, but it could play out well. So let's see how it looks with just $1 million transfer. You can add some zeros to this, and in this particular case, it's a 99-year GRAT. Sometimes you don't have to go out a whole 99 years. Sometimes you would go out simply, you can do it with 20-year, 30, 60 type of year GRAT. And again, the two factors that are at play is how long the term is. That sets an annuity, and then and then it's interest rate sensitive. So in this particular case, the $1 million transferred in August when it's 0.4%, 99-year rate. okay, if you believe that when your client dies, the interest rates will be higher than 0.4, then this is something to consider, to stuff some of your assets in. So for example, if to zero out this at $7.31 for transferring in $1 million, that's your taxable gift. You'd report that gift on a gift tax return, get the statute of limitations running, all that kind of good stuff. But if the rate simply goes to 1.0, okay, that $1 million would include the whole grat. So to back up a step, most people in the literature out there says you don't outlive the term, you're going to have the whole thing come back in the estate. In this particular case, the only amount that is actually required under regulations, the current regulations in 2036, is simply the amount to pay the annuity in perpetuity. And there was, there's case law on that. That's pretty well settled. It wasn't always that case previously, and so you can see here, you can get quite a discount. Let's just go down to like 2.4 there. If it goes up to 2.4, the original $1 million, let alone whatever it's appreciated, it may have doubled, over 6 or 7 years, it may have doubled in value and kept on that. But what will be included in the estate? Well, only maybe about half of it. So basically you got 50% discount on your initial seed money, if just in the interest rate play. So it's pretty powerful, but you have to be careful with the long-term grat. Another attorney I've been involved with an audit. Will the IRS accept them? You have to negotiate through that. Generally, they should accept the 90. It was a 99-year grat. There may be a little bit of pushback. Again, it's not for the totally risk averse, but it can be very, very, very powerful. So next slide. Let's go on. Okay, so grats versus idiots, just really quickly here. I mentioned the GST, grats are not very friendly. They are good for transfer from one generation to the other. The family I just mentioned that transfer a significant amount of wealth over probably a decade. They have to start all over again and start doing grats from that one to the next one. As opposed to idiots, which Phil will address that. We both salivate over that one, but he got the short straw, and he gets to do idiots and talk about that in just a minute. So there's a recent case, fairly recent, at least on the appeal, the Badgley case, just came out. It was a 15-year grat. It's kind of a good example of how not to do it, but it's easy to take pot shot at it because it was done way back in February 1998. This is the interest rate going completely the wrong way. Believe it or not, this 75-20 rate way back then was 6.8%. So it wasn't likely to get, it went the other way. When she died in November 2012, it was only 1.2. So of course the whole thing is going to be includable in the estate. When you have interest rates going that way, it would have been the greater of, you just take the annuity, divide it, perpetuity, it would be the lesser of 30 million. Well, that wasn't that much, but there was a whole 11 million. Again, they only started out with 2.5, and it really did grow, but the whole thing came out, and the person died and missed it by about 3 months as far as outliving and getting that whole 11 million out of their state. So that's not the right way to do it. But had the rates gone the other way, there would have been a discount and it would have worked. So they are an interest rate play. If they had done a skin in this particular case, they would have come out way better with as far as a wealth transfer. And the result is not surprising. This Badgley case really does cement in, once again, saying that you do use this formula under 2036 that I've just described in long-term grats, and that is the way you evaluate it. So in many cases, you're going to include the whole thing, but not in all cases. If you can get that, if the interest rates go the right way for you, there's future appreciation. And so that's a little snippet about grats, long-term grats, cascading grats. I'll turn the time back over to Phil to go forward.
Hey, thanks, Mark. So Mark, just real fast before we transition, do you see clients more inclined to, your clients more inclined to do grats, or do you see them more inclined to do de facto grantor trusts?
We see a preference more for the defective grantor trust strategy most of the time. If you have the luxury of time and in certain situations, the grats work better. And sometimes in the, you know, for example, the family I mentioned, they do both. You know, they have they're using them all, but the other strategy, you know, you can just set it up and let it cascade and roll, and it worked beautifully in their particular case.
Yeah, so I have the same comment or experience. I think people like the Grantor Trust better, but the clients that have done grats, once you get through kind of the first round, at least with the short-term grats, and then they, you know, it's the same thing over and over again, they get very, very comfortable to see it kind of roll out.
Exactly.
Okay, so let me make sure I time myself. Let me transition over to intentionally defective grantor trust. So I started doing these in the late 90s when I was at Loose Forward. And I remember the first time I went through them, I was kind of like, wow, this is pretty neat what they did. And what they did was, I mean, the grat is a statute, it's there, you follow the rules and you should be good. Like Mark said, there's interest and there's valuation games you can play, but it's a statutory animal. What they're doing here is they're taking income tax statutes that were addressing income tax abuses and using them to the advantage of the estate planner. So this is how it works. So the Internal Revenue Code section 671 through 679 set up when, you know, who pays the income tax on a trust, basically. And so they put these statutes in to stop what we call income assignment of income. What they wanted, what the IRS wants to do is tax the highest income taxpayer, not the lower income. And they were sensitive, so they put these statutes in there. I don't know if they realize how beneficial they are to the transfer tax attorney. So the transfer tax attorney now uses these statutes to their benefit. Next slide, Charlene. So I'm going to go through the basics, and then I'm going to talk to you about the trigger options, the income tax reporting, and then we're going to talk about sales, and then we're going to talk about swap powers. And then with the sales, then we're going to dovetail into Mark, and he's going to kind of talk about other options with these sales with skins and private annuities and how they kind of, again, amplify this. So next slide, Charlene. So basically, sub J of the Internal Revenue Code sets out the procedures on taxation of the income for estates, trusts, and beneficiaries. And I don't know if you've ever downloaded one of those apps that has the income tax rates, but you can find them in the App Store. And you go through and you see the top, when you hit the top bracket for individuals, you know, head of household, joint filers, and then you look at the trusts and estates, and you hit the top bracket at $12,950. So what we always tell people are inside an irrevocable trust, not a revocable trust. An irrevocable trust, you have compressed brackets, so you hit the top bracket quickly. So typically people do not want to trap income inside an irrevocable trust because you'll hit the top bracket. So how to avoid that is you can then, number two, pay it to the trust beneficiary. So you would K1 it out to the beneficiary. They would then report it on their income tax return and pay it at their income tax bracket. But this is where the sub J comes in. The other option is actually to tax it to the grantor. And there's also, you can tax it to another person deemed a substantial owner, and that gets you into the BDITs and the BDOTs, and we're going to do those probably in another presentation. Next slide, Charlene. So 671 sets out the statute, and 673, 678 set out the rules, and basically designed to avoid income shifting, and the transfer tax attorneys have used it to their benefit. Next slide, Charlene. This is actually the code section for 675. So there are a bunch of trigger options that you can see them there. Power to deal with less than adequate or full consideration, power to deal with adequate interest or security. And then in number 4, there's a few, but the one I want to focus on today is 675-4C, power to reacquire the trust property by substituting other property of equivalent value. Next slide, Charlene. So the estate planners typically go to certain ones, I've pretty much routinely either used the loan power or the power to substitute assets. And I'm going to show you why I use the power of substitute assets as I go through some of these examples. But next slide, Charlene. Here's the basic setup. Again, you have the Grantor Living Trust on your left. That is just their California Living Trust, and it's revocable and it has all their assets. And then the slide on the right is the idea of a Grantor Irrevocable Gift Trust. So they call them intentionally defective Grantor trusts. I always thought that was a misnomer. I don't think they're defective in any way. They're actually really productive, and they should be just called Grantor Trusts. So what we're doing here is we're setting up a trust where the grantor or the trustor is your client. The trustee, and there was a question, who should be the trustee of these trusts? It should not be the client. And who should it be? Should it be the child or a third party? We actually did a presentation on who should be the trustee a couple of years ago. And that's a whole topic unto itself, but it should not be the client. It's best practices to have a third party trustee, or you can think about the beneficiary. And then the beneficiary in this example is the child. So what we do is we create the trust, and then we specifically look at the Grantor Trust rules, and we intentionally trip that wire to make this trust taxable to the grantor. So in my example, we would give them the right to swap out assets under that 675 section. By having that provision in there, this makes them the income taxpayer. So let's just do a simple gift. They take stock or partnership or a piece of real property and they transfer it in. Again, they allocate their gift tax credit to it. They allocate their generation stipend tax credit to it. If they want to make it not taxable in the child's estate, they will file a Form 709. And again, if they want to go to Delaware or another jurisdiction, they can even amp it up even more. But let's just say it's a straight up California deal. They put the property in there. Let's say that property is rental property. The rent is $3,000 a month. The $3,000 that is earned by the trust is taxable to the grantor. It is what you call phantom income. So they don't get the money, they don't own the money, but they are responsible for the income tax based upon those grantor trust rules that the transfer tax attorney put in there to do it. So I have had clients go, why is this good? Why is it good that I'm actually paying income tax on money that my kids or that trust I set up for my kids get? And I tell them, okay, if you're required to pay the income tax, that is a free gift. Put another way, if they wanted to pay my income tax and they said, Phil, well, I'll pay your income tax, and they cut a check to the IRS, they made a gift to me of my income tax. But if they're required to pay it, it is a free gift. And how that works, the free gift then is a drain down on their estate. So simply put, you transfer the property in, it generates income, and whatever income tax liability, and for illustration purposes, we typically just do a 50% income tax, and we're getting close to that in California anyway. And I say 50% of that, you're gonna pay the income taxes on it out of your assets on your Grantor Living Trust. That is a free gift. So this is literally the gift that keeps on giving. And so you have to explain to the client that they're going to be having this phantom income on their personal income tax return, and that you need to work with a good CPA, that they understand how to do that and how to report it properly. And then you see this magic. So we set one up for one client. The first one I did was with Jack Charney and Fred Vanderveer at Luce. We did it in 1997. And the guy, I think we got to 2008. And he finally said, I'm tired of paying the income taxes. I don't want to do it anymore. I've done enough for my kids. Let them pay it. And there is an option to turn off that power. So go to the next slide, Charlene. Okay, so before we get to the sale, what you can put in there is a toggle switch, and you can say, you know what, I'm relinquishing this right to swap out the property now. So now I'm not the income taxpayer any longer. and then the trust becomes the income taxpayer, or the trustee K1s the money out to the beneficiaries and the beneficiary becomes the income taxpayer. In any event, when the grantor dies, the grantor trust status will end. So in California, how we set them up, we actually do separate trusts for each of the spouses if it's a spouse situation. Mark, do you want to add something?
Yeah, you mentioned about toggling off the grantor trust power. Phil, would you ever recommend, once it's toggled off, to ever toggle back on?
Yeah,
I think there's
no, go ahead.
I think that's not a listed transaction, but it's a transaction of interest, so not really recommended.
Yeah, so most of the ones that I've done, we've only had a one-way switch, and there are other ways to toggle back on. I mean, you can make loans from the trust, and there's other ways you can kind of manipulate that. And again, started talking like the long-term grats. You got to talk to the client about their, how we say, your audit stomach, and do you want to get audited? And I've had clients who are pretty courageous on that, and they'll push the envelope, and then those don't get audited, of course. And then I have other clients that are audit sensitive; they never want an audit. So you can talk to the client about that. But in most of the ones we've been doing, it's that old thing about, was it pigs go to fair and hogs go to slaughter? How much do we want to press the line on it? Back in the day, when you could only gift $1 million, the grats were great because you could zero them out. And then this was a way to do it, but you had to manipulate to get enough money in there because you can only gift $1 million. Now you could just simply gift 20 million or 10 million and have that grantor trust status play out, and then you're draining down the estate. And of course you can get a good valuation on that. That's fine, but it's simpler. Okay, the second slide, the step 2 slide, envisioned a sale, and the idea of the sale really came out when we didn't have large credits from the gift tax, but now we do. But still, people like to do these because they actually want to sell the asset, but they give it away, but they want money back from the asset. And this is how this one works. So again, you set up this trust. In my example here, I've done a swap power to make it a grantor trust. So you'll have to have the trust with some sort of substance. So you can't have a dry trust. You'll have to do some sort of gift prior to this to give it some value. So practitioners talk about how much, depending upon the amount of the sale. There's usually like a 10% rule. But a lot of times I like to set these up, put some gifts in there, let them run for a while, and then think about a sale down the road. Okay, so the idea of the sale would be to find an asset which you can provide favorable valuation, and Mark's going to talk more about the valuation. And then the grantor is going to sell that asset to the trust and take back a promissory note. Now, if you sell, you should say, whoa, wait a minute. You're going to have capital gains because it's a sale. But in this situation, you're not going to have capital gains. Why? Because the grantor trust, the taxable person is the grantor. You cannot sell to yourself. So this sale from the grantor living trust to the grantor irrevocable trust is not a taxable event. And so there's no capital gains due at that time. You take back a promissory note, then it becomes more of an arbitrage because you will have to charge an interest rate. You at least have to charge the AFR depending upon if it's a long-term note or a short-term note. And then you'll have to respect the deal, make the interest payments and things of that nature. And so with pretty much every one of these that I set up before the credits went up, Mark, I told my clients, I want to amortize and I want to pay off that note before you die. And I've been fortunate. I only had one that didn't pay off, but all my other ones we paid off, or when the credits went up, we paid them off. So one of the questions I had for you, Mark, is have you experienced a situation where you've had the client die with the note in their estate?
We have. It raises it interesting, and there's all kinds of literature out there, whether or not that note is IRD or not. I think the majority of the practitioners out there would say it's not IRD, was not capable of having a gain under Rev Rule 85-13 during lifetime, therefore it's not IRD, yada, yada, yada. But It does raise an issue, and a lot of people do like to have it paid off so they could completely avoid the issue. Otherwise, you're faced with it and you have to take a position on it. But we take the position that it is not IRD and will not accelerate the gain.
Yeah, and then Mark, when you guys do the sales to the trust, what we've done is we've reported the sales on the 709 as a zero value. Do you guys do that routinely as well?
Often. I know that practitioners such as yourself and some others out there really believe that's the prudent course of action to get statute of limitations running. I really understand that. But sometimes there may be other factors in the valuation issues, et cetera, where they're a little reluctant to do that right then. So it could become an issue later down the line on the estate tax return. Yeah,
so I mean, I did the same thing when we initially did these. There's sales, so there's not a gift. So you report the seed gifts, that's for sure, but we never reported the sales. And then we started reporting some of them with the idea of starting the statute of limitations. And then I've been fortunate, pretty much when the credits went up, most of my clients were did not have the audit stomach, and they did pay off the note. So I haven't been dealing with that. And then the last question I was going to ask, and I'll go on the next slide just to get your thoughts on it. What's your position on what the basis would be of the assets that are sold to the Grantor Trust? Do you think it's transfer basis? Do you think it's cost basis? How do you guys come down on that?
Well, on a regular structured garden variety idjit type of thing, we believe that you're talking about the idjit assets themselves, whether or not they get a step up in basis.
Yeah.
So there's a minority view going out there that you would get a step up in basis, but we don't think that will follow. I've actually had conversations with the national office on that particular issue. It's one of their guidance projects that they've had for about 3 or 4 years. I'm waiting any day now for guidance on that thing. I know what their position is going to be when they do come out. I think if you've read the Austin Bramwell and Stephanie Vera wrote an article a few years ago in Tax Notes, they will take the 1015B carryover basis approach. And I think that's pretty well thing. But I mean, there's some well-respected people, pretty smart, that back east in particular. I mean, if I were to name names, I could. Jonathan Blockmeyer, Mitchell Gons, and some others that have written some articles on there. I don't buy it, what they have. So that's my viewpoint of it.
Yeah, I don't disagree. Okay, so just finish up on this slide then. The sale would be completed. Now the Grantor Trust has the assets, and again, there's dispute as to what the basis of those assets is, whether it's a transfer basis, whether it's a cost basis. I've always, at least where I was trained, you had to have a recognition event to get the cost basis, but there are people that take that position. In any event, it has a basis in there, and then time goes on. Okay, next slide, Charlene. Okay, so now you say, when does the Grantor Trust status end? At the death of the grantor. But if the grantor dies, those assets in that trust, it's my position, they would not get a step up in basis. But assets held in the grantor's estate will get a step up in basis. So next slide, Charlene. Okay, so this talks about the swap. So you find out that you have an elderly grantor, and in the Grantor Trust that you set up, the irrevocable trust, there's low basis assets. So the reason why we have Grantor Trust status was we retain the right to swap out assets for the same value. So this slide shows you what you can do. Assuming the grantor has the cash, which is the ideal situation, is he swaps cash back in, and then he swaps out the partnership assets. So then now, when the dust settles, the Grantor Trust has cash instead of the LLC or the partnership or the real property. And now the grantor has those assets in his estate again, or her estate. And then when he or she dies, they get stepped up in basis. So here, going back to the original idea of the interplay between the income taxes and the estate taxes. Here we're beating all the taxes. We're beating the estate tax by transferring those assets over, and hopefully there's been growth. There's been a drain in the value, and we've also frozen the value in that trust by the sale. And then, but you say, oh, you're going to lose the step up. You swap it back out. Now it's in the Grantor Trust, then you get the step up in basis. Okay, next slide, Charlene. Then what the Grantors, go ahead, Mark.
Oh, Phil, just real quickly, would you set up ahead of time the ability and the mechanisms to do that swap
Yeah,
prior to
I mean,
one's demise? I mean, getting all the things ready for that?
yeah, so, you know, again, planning ahead and talking to them about it. I remember the first time, because I was so excited about the Grantor Trust and how it drains the estate, you know, it just burns the assets of the estate tax-free. And then people go, well, hey, you can use the swap power and put it back. And I was like, oh yeah, that's a really good idea. I can remember the first time I hit that. And then
Well,
after that,
you may
I got that in my head.
You may want to have good banking relationships in case you want to borrow money to effectuate the swap, and set up your documents so that you can execute them at the right time when you get the call. Your mom's not doing well, things like that. So anyway.
Yeah, absolutely. If you want to set it up so that you can do this. And I've just been pulled into one about 3 years ago, and another CPA I'm working with, he engineered it. And I came in late in the game after the, and actually the husband was alive, and they did the swap, and then he died. And when I took over the case from another estate planner, and I looked at it and I said, oh my God, that's CPA, holy smokes, what a great thing they did. And they did the swap. And then here's talking about, this slide's talking about the repurchase thereafter. So now they say, okay, we got the stepped up basis, and now we're going to sell it back to the non-grantor trust. And that's a sale, but of course, fair market value, so there's no gain. And then the cash would go back to the grantor's trust, whether it's an ABC trust or what have you. And then it gets the stepped up asset gets back into the grantor's trust. Which is now a non-grantor trust. So I'm going to transition over to Mark in a second, but now remember that assets that go in that non-grantor trust, when now there's income on that, they will either pay it at the trust compressed rate, or they're going to K1 it out to the individual. And on those lines, Mark, about giving people notice, you tell those beneficiaries, hey, by the way, now you're going to have to pay income taxes on it. And I've had beneficiary goes, well, that's not fair. And I go, are you kidding me? You've had this free ride for the longest time, and now your mom and dad are dead, and you got to pay the income taxes. That's the way it goes. And it's fun to work intergenerationally, but at least set the kids up so they can see that down the road. So talking about the sale and valuation, and this is one of Mark's expertise, is what can we do and how can we structure that sale? Because I haven't really focused on valuation of those assets or how to work out the sale documents. And Mark's going to talk about private annuities and self-canceling installment notes. Mark, if you would, I know you have better knowledge of the value cases for Wandry and Wobing. If you can maybe give us all a primer on that as well, that'd be great.
Well, it's probably, I'm looking at the time, it's probably beyond the scope, but you do have these defined value cases, Petter, Wandry, McCord, all those, and some recent developments there, and where one can have a formula clause as to perhaps to peg the value a little bit better using a formula. However, again, given time constraints, I don't think I'm going to shift that one for a further discussion at another time at this time.
Yeah, and then what we can do is perhaps set up another series and talk about that, because those cases
that's
are pretty exciting. But you can play with the valuations and have almost like an escape hatch. So then we'll talk about the skins and the private annuities.
Okay. All right. So this is another level of marrying or balancing, if you will, bet to die type of strategies with bet to live type of strategies. A lot of the things that we've just previously, the IDGIT, which Phil just talked about, is a bet to live strategy. If you live long enough, you're going to transfer a lot of wealth, shift it over to the trust, and it won't be part of the gross estate. It's a bet to live type of strategy. And one of the better bet to die strategies, if you will, is life insurance too. You can balance, for example, I mentioned before with the GRAT, where you could balance that out with maybe a life insurance policy if you think they're going to die during the term or that type of thing. So those are some of the balancing. So I'm now going to launch into, for just a few minutes, another type of bet to die strategy called the self-canceling installment note. And another one that's very close to it is called private annuities. And the whole idea here is what if the is to cancel out the note or to have the private annuity. Let me cover private annuities just briefly. Those are more creatures of the statute and regulations, and whereas self-canceling installment notes really come out of a body of case law starting back in 1980, I think was the state of Moss, and there have been Constanza and a few other different cases along the way, but those are more case law based type of propositions. And so while they actually will stand up, you can get more pushback. We'll talk a little bit about that if we can get to the Davidson case and CCA 2013 in the 2013 type of approach. But backing up to private annuities, sometimes we'll come up to a client and say, just ask the basic question: how much do you want to live on for the rest of your life? What is, come what may, amount? Is it $200,000, $300,000 a year or bigger? It's different for different people's lifestyles. And maybe they say it's 300,000, and given his current age and stuff, we say, okay, well, we can transfer over maybe 3 million into your trust. And then now the trust is obligated to pay you an annuity for the rest of your life. And it never expires. It expires when you do. And the idea is that that person would consume that amount of amount. So his estate never really increases. And that $3 million or whatever the figure is that you determine under the 75/20 rate again, which is really low and makes this more advantageous, that is permanently outside of their estate. And they have that money to live off. So I do like private annuities for a particular thing. The caveat with private annuities, of course, if you're selling to a fixed entity like a trust, there has to be sufficient assets in the trust. It has to be well funded, just like Phil mentioned, previous gifts and everything, enough equity there so that that annuity can survive for 110 years, regardless of whatever the mortality tables say. You need to be able to satisfy this 110-year exhaustion test. But if it's a well-funded IDGIT, and that's why I think one of the takeaways that everybody is talking about right now is start your planning now. Get your IDGITs in place now before the end of the year. And Phil will probably come back on and that idea. So you can do some of these other things like a private annuity if you want to do that. Now let's move on to the next slide on the self-canceling installment note. Okay, so again, the whole idea is a reduction of the estate tax if there's a premature death that occurs, and you can cancel out the note. What Phil talked about earlier, he talked about the benefits of the IDGIT. He talked about the freeze, being able to freeze assets and squeeze them down with discounts. We didn't really get into valuation, but also about the tax burn of the grantor's estate. Those are all great estate planning things. But what if one could take that note and just make it go away? Well, you can if it's structured correctly under these case law that I just mentioned. To make that happen, you have to either increase the principal amount of the note when it's due, or you have to increase the interest rate of the amount that's due. That's a so-called premium for the cancellation feature in these particular notes. Next slide, we'll see how that. So there are a couple different ways of skins that we talk about. I just mentioned a skin int, which is where you increase the interest rate. A skin prin is what we talk about when we would increase the principal. And you can actually have a combination of both, increase the principal interest, and they're mortality type sensitive. Speaking of mortality, there's a mortality skin where someone has a compromised health condition, but they don't have a terminal illness in the sense that they're expected to kick off within the next year. But maybe something something better than the mortality tables are indicating to you. That would be a prime example where skin would really come in. But in those particular cases, you really do want to get a doctor's letter that basically says they have at least a 50% chance of surviving a year, so that the presumptions are that you can use the mortality tables normally to compute the risk premium. It's kind of an art computing the risk premium. I'll talk a little bit about that in just a second. The other situation, again, is to use these as a hedge with other types of strategies, a hedge skin. Okay, next slide. Need to move along. So this is an example of somebody that was used to doing skins. The amount is not all that significant, it's $1.1 million, but this person had done skins in the past, and every once in a while his estate would accumulate too much cash, and he has a nice dynasty trust set up, and he'll think, well, okay, maybe it's time to do another skin. And it gets he's now 82 and did one fairly recently last year. And as you look over here, you can see the interest rates can get pretty significant, almost 13%, paying to adjust for that particular thing. Or in this case, he decided there was enough cash flow in the trust and whatever to pay him back, did a 10%. So he actually, there's a little bit of addition to the principal amount. If he outlives the particular term, which is 8 years in this case, then that will all become due and payable and have to be repaid back to his estate. But if he dies anytime during that time, theoretically, the note just goes away and his heirs come out the winner. So it's a bet to die type of strategy, but it can be married with other types of concepts. And that's basically everyone, including Number Cruncher, which this comes through, uses the typical mortality tables to adjust for this. The service sometimes will take, again, a viewpoint, which they cannot do with private annuities, but they can with self-canceling notes. And so we actually need to use the actual health history of the individual in computing this so-called risk premiums, and can sometimes, in certain cases, we'll try to adjust that. That was the case in a Davidson case, in a little bit of guidance that they adjusted. They attempted to do that, but that was settled on favorable terms. But anyway, this gives you it's a good tool. It can be used, and it actually is viable. Next slide. I think that's a quick wrap up for me, and I think I need to turn the time back over to Phil for a couple other ideas.
Yeah. So real quickly, Mark, do you see your clients interested in the skins and private annuities, or is that too exotic for them?
I'm seeing more and more, and so yes, we do consider it, and we're seeing more. Again, the private annuities I like to use for a particular space for the consumable discretionary income that they were going to use that, and then if there's an additional amount that they want to perhaps exclude from their skin, we will consider a skin in the right type of situations. Even consider skins for the fairly younger type of situation, because the premium with the rates being so low, I mean, you could take a 50-year-old and, oh, gee, maybe they'll have to pay 4 or 5%. That's not crazy. That's not crazy money on a yield of some of these assets, particularly when you discount them. And so, to get a cancellation feature for 25, 30 years, just in case they die prematurely, I mean, it really didn't cost anything with the cash flow, and particularly when it's not taxable. So yes, I do see some situations where it's appropriate to consider the skin.
Yeah, so same thing. We've been looking at it more and more in the last couple of years. So just to kind of wrap up, what I wanted to do is talk about a liquidity analysis that should be done, and then talk about this election in the 2026 sunset. And actually, I wanted to kind of get everyone's thoughts on that, on what's going to happen. But the liquidity analysis in this situation, when you have these large estates, if you have like $100 million estate, I said the math's pretty easy. You know, you take 23 million off, and then you, if it's a $123 million estate, you get 23 million you're not going to pay tax on, and then it's 40% of 100 million. It's $40 million tax that's due 9 months after the second death. And then where are you going to come up with the money to pay that? So again, you know, simple stuff with the ILETs. I just think they're just incredible vehicles. If you can lock them in when people are young, it's amazing. I also talk to my clients about, they say, I want to help my grandkid. Excuse me, I want to help my grandkid. And I go, okay, then get some cash to your kids. Their lives are younger and cheaper for life insurance, and get them to do life insurance trusts. And you can kind of avoid the generation skipping tax just by giving them a gift. But this opportunity now with these high credits are there. The difficult estates, I think, are the $20 million estates, because here you got 20 million, you're not going to pay tax. And then if the election changes things, or in 2026, that's going to be cut in half. What to do? That could be a whole separate topic, and talk about slats and things of that nature. But the point that I wanted to say is that liquidity analysis should be looked at, and, you know, can you plan ahead for it? And then two other options are to pay the tax are Gragan loans, which again could be another entire seminar, as well as 6166, you know, fitting into that to delay the estate tax. And then remember, you don't have a tax until the second death. So with husbands and wives, it's at the second death, not at the first death. So it'll give you some time. And I tell clients, when their spouse dies, your expenses go down because there's going to be only one person instead of two people. But at least to look at that liquidity analysis and know it's a moving target. Then what to do about the election, and what to do about 2026. So the election is very interesting, because you really have to have the stars align to have a tax reform. I always say, I think Congress is doing as good at doing one thing, that's nothing. So odds are they do nothing, and I could see that happening. But you need to have a Democrat in the White House. You need to have at least 50 plus Senate, and then the House staying on the Democratic side. The things that I've seen with Biden seem to be less draconian than with if it was Bernie Sanders, or with wealth taxes and such. But with stuff, I think they were saying with Sanders is maybe 3.5 for the exemption, and then I don't know if they're going to raise their rates or lower the rates. But you know, should you do things prior to that time? With these larger estates, these $150 million estates, I'm with Mark. I mean, if you have that much money and that much wealth, to take your 20 million and get it in the can makes absolute sense to me. I wouldn't wait. I would just get it done. Yeah, you want to gift high basis assets. If you do low basis assets to the Grantor Trust, then you could swap them out later on. That seems to be a no-brainer to me. Most of my high net worth people, right when the credits went up, they already completed the gift out. Because as the gift gets out and the appreciation moves forward, then it's benefiting everybody. So, but you know, to run in fear that the Biden's going to win and there's going to be this big sweep, I don't know, for the $20 million estates, to give away 20 million or even to do slats makes me nervous. I see clients that are coming into my office, they're in their 90s. So you got to plan for a long life, you got to plan for markets going up and down, and you got to plan for health insurance and healthcare costs to increase. So I'm all for saving taxes for the more modest estates, but you really got to be sensitive and make sure you're taking care of your clients. But if you have $150, $250 million, I have one client who's got, you know, over 750 million. We've already completed those transfers out. Sometimes they like to keep a little bit of credit so they can do some giftings down the road. But I would think to do it, if you want to hedge a little bit, I've seen people doing one spouse's credit, then retaining the other spouse. so that if it does retract back to 2026, you'll still have 5 million, and then the one spouse will use their 10 million. There's things of that nature to do, but at least to address it. And again, making sure you have the appropriate powers in your trust documents and your powers of attorney so that your kids can complete these gifts, tax gifts, if it makes sense at that time. Mark, what's your thoughts on the 2026 sunset in the election?
Plan to do it now and sooner, you know, to get something in place and rather than wait. I know sometimes gets to be a fatigue factor with a lot of these clients, having heard in the past, you know, you better use up your exclusion or what have you, but there are prudent ways to leverage it and use it, not only use that exclusion amount, but also to do further planning. Again, I think getting the IDGIT set up now is really, really important. And also, I think you could consider maybe some of the GRAT strategies, maybe you can get those in place. If they do change the law, some of those will probably be grandfathered and situations. So I know under the Obama administration, for example, they were wanting to set an outside term of the life of the grantor, life expectancy plus 10 years. So, you know, you could do some of these things now, but the important thing is, I think to do it, particularly when the rates are so low. You add some zeros to these things and it really makes it, this is the golden age for doing a lot of things. And don't forget about charity and good organizations like the JCF and others, because there are some really powerful things with charitable e-trusts, which we can't get into now. So yeah, this should be a heyday opportunity to do a lot of really good planning, and expect to be busy between now and election time and particularly after that. So,
Mark, what do you think about 2704? You think that would make another resurrection later on if the administration switch?
It could in certain situations. The service tends to take different viewpoints, litigation strategies, and every once in a while they'll do a test case and try to make some inroads, particularly in the valuation issues, some other areas. Whole nother topic.
Yep. So
I think it's time for us to address some of these questions if we can.
Yeah, Roberta, you want to field the questions you want us to look in?
Thank you so much for your presentation. It really gives me a really big picture on some of these really big ideas. The first two questions have to do with ILITs and insurance. The first one says, Phil, you mentioned an ILIT is a great strategy for younger clients with significant wealth. Would it also be appropriate for healthy, insurable individuals in their 50s, 60s, and 70s? And if I could add in the second question, in order for these trusts to work, is it best to have the client serve as trustee or to have a neutral professional serve? Does New Hampshire work as well as other states you mentioned for jurisdiction?
Well, let me do the second one first. Yeah, pretty much best practices are not to have the trustor as the trustee. It just makes sense not to do that, to have a third party trustee. Insurance trusts are so easy to administer. I think you can get someone to do it, and it's not a ton of risk there. That being said, the insurance policy is an asset, and you want to make sure the trustee's looking at it. So I like third-party trustees or have the child as a trustee. As far as New Hampshire, gee, I honestly don't know. Mark, do you know if New Hampshire's a good jurisdiction for these type of deals?
Surprisingly, it is. Yeah, it hasn't gotten as much press time as for certain types of trusts. It is, but you know, we've talked a lot about grantor trusts. If we were talking about non-grantor trusts, we could select different type of jurisdictions for those type of considerations. But that's a separate asset protection and INGs and those type of things, and the jurisdiction there. But New Hampshire actually has a very favorable, if you're looking for dynasty type of things and just general good, they really come a long way than where they were before. So
Well, that's good to hear. So I've usually, I mean, it's funny you do it, you know, I've usually defaulted to Delaware because
Yeah.
they have the good corporate laws, and I like some of their other provisions out there. Um, but we've done, again, South Dakota. And so I guess you have to look at that. And again, you got to work with an attorney out in those jurisdictions because I mean, I'm not licensed there. So you'd have to liaison with an attorney out there. And then on the insurance question, yeah, I mean, it's a cost issue on what it would cost to get the insurance. So it can't hurt to get some quotes. And yeah, I don't know when the tipping point is. You know, I'm 57 going up 58. I know my horizon's getting lower, but if you're healthy, you can check it out. And especially with the credits the way they are now, you don't have to worry about the gift tax issue the way we did with $1 million. So I just see some of these entrepreneurs, I mean, I'm going to call them kids in their 30s, and they're just ringing the bell, and they don't have a trust at all, and they don't have any life insurance. And to me, when they're that young, it's just such a no-brainer. The other thing I wanted to mention on the swap, I forgot to mention this, is Mark, have you ever done with a swap to a defective grantor trust, putting life insurance in to avoid 2035?
Yeah, there was, people were a little bit reticent about doing that back in the day, but some favorable revenue rulings came out. And so, okay, using, you know, where you can swap actually swap the policy out with good grantor status, and if you need to. Yeah, so I'm okay with that.
Yeah, so that's another reason why I like the swap power. And with the 2035, there's a 3-year rule. They bring it back in if you gift it, and if you swap it out, it seems to avoid that 3-year rule. So yeah, I think to look at life insurance on everyone, it can't hurt to at least quantify it and see if it's viable.
Then we have 3 defective grantor trust questions. I'll try to consolidate them. With the use of the increased exemption, so your clients who pay off the note on the defective grantor trust simply file a gift tax return and treat the completed sale as a completed gift transfer? That's a question. And does the defective grantor trust make sense when the kids pay taxes at a significantly lower rate than the grantor parents? And finally, what circumstances make using the 2 defective grantor trusts, husband and wife, better than one trust?
Yeah, so what I've done on the note payments, when the credits went up, the clients just wanted to get rid of them. They gifted the cash to the trust, so it was a cash gift. And then they paid off the note. That's how we did that one. I don't know, Mark, have you forgiven the note? Have you done those to get rid of the notes?
Yeah, as part of, yeah, as an additional gift. And you could treat that as a, on the 709 gift tax return, you know, and report that and get your statute running if that's part of the question. Part of the question might also be trying to address on the initial sale, do you report it as a non-gift because it's for full and adequate consideration? And some people do and some people don't. And to get the statute running there. So good question.
Yeah. So then with respect to the grantor trust, so when the person passes, the grantor trust status ends. And so most separate property states, you don't have a joint trust. California is community property state, so you can have a joint trust. So what I've done, just how I was trained, is we set up separate trusts. And then the reason I like that is sooner or later, when one of them passes, if they don't die together, you're going to have half as grantor and half non-grantor. They'll split at that point. But by having it as a separate trust, it also gives you another toggle. So if it's the husband and the wife and you want to turn off one and have tax paid and keep the other one, you can do it that way. So it's kind of a hedge. We've administered ones that were joint trusts, but I've always just routinely done the grantor trusts, one for each spouse. I don't know, Mark, have you done joint trusts or do you do individuals?
We see both. It makes, from an income tax reporting standpoint, it makes it a little messy when you got a half a grantor trust and a half not. But you know, we've reported it that way on a forward-going basis. So preference is to keep the grantor separate and have a transmutation document so that community property state, so that we have, you know, good, clean, separate grantors. But I've seen them joined together. I'm not adverse to it, but it does make it a little bit messy after one dies and you have a half, you know, you have a half of one and half of the other type of situation that you have to report that way.
Phil
So,
and Mark,
I do have a preference. But I've seen both. Okay, sorry.
I'm sorry, I've been told it's time to wrap it up. I could stay all day listening to you. So thank you so much for really an outstanding presentation. And Charlene, we're going to sign off now. You're in charge.
Thank you, everybody, for participating. And I'm sure there are lots of questions that will continue. And I know that Bill and all of you will look for opportunities to create sessions around these very important and really quite fascinating topics. So thank you all. Thank you to our presenters. And most importantly, a big shout out to Bill for always pulling it off and getting these things together. So we look forward to next month. It's a big event. And we encourage you to look out for that email and register quickly.
It'll be a good one. Thank you.
Thank you. Thank you very much.